And a new warning for investors today from one of the legends in the business, Bill Gross. In his latest market outlook, Gross said central banks have gone too far by keeping interest rates too low for too long. The effect of this race to the bottom by central bankers, he says, could seriously harm pension funds and insurance companies. Bill Gross, who runs the Global Unconstrained Bond Fund at Janus Capital, is with me now. Welcome to the show. Great to have you here.
Thank you, Gerri.
And let's talk about that warning that you're giving to investors. Here's what you said in your note. We read it every time you put it out here. Central banks have gone to and continue to go too far in their misguided efforts to support future economic growth. Tell us about that, and why is this hindering what the economy could be doing?
Well, let's talk about the several positives of negative interest rates. One, they lift stock prices and they lift bond prices, and so, capital gains accrue, and some of that trickles down to the economy, and so that's pretty much of a benefit. The negatives, however, are not well recognized, Gerri. One of them being that pension funds and insurance companies have really long-term liabilities. Retirement and, of course, death benefits in terms of insurance require, a long period of time and a relatively high interest rate in order to pay off those obligations. And so when interest rates go negative, which is what they have in Euroland for the past several months, in some cases a negative 75 basis points, then insurance companies and pension funds are certainly under the burden of low interest rates as opposed to high interest rates.
I look at that and I also think that retirees, people who are close to retirement, people who might want to save and get earnings on their savings are being killed here and have been for the 6 years we've been in this zero interest rate environment. What would you say to those folks tonight?
Well, I think that's another good example, Gerri, in terms of households. I mean, they have certain expectations in terms of either education or retirement or health expenses going forward. And for much of the last 5 or 10, 15 years, those expectations have, required interest rates of 4, 5, and 6% in order to pay, for those liabilities. Now, in the United States, with short-term interest rates close to zero, and you mentioned that savers, are being disenfranchised basically in terms of their ability to make a return on their money. Yeah, then there are problems for households as well. So it's not just business models, it's individuals, families, and households that really require a positive return on savings, and probably at least a 1 to 2% positive return on savings in order to pay for what they hope to achieve in the future.
And we hear from them all the time. My other concern is if the economy endures some other kind of shock, what can the Fed do then?
And that's a good point, too. And I think that's why the Fed in June, or perhaps in September, but I think in June, will try to raise interest rates. They know, as you point out in 2008 and 2009, that the ability to lower interest rates dramatically from 5.25% on the short-term level to near 0%, helped to salvage and support the economy for the next 5 or 6 years. If we get into another period of slow growth or recession, then there needs to be the ability of a central bank, the Federal Reserve, to lower interest rates to stimulate the economy again, like they did after the Great Recession.
So how quickly do you think the Fed will raise rates? How fast will this come? And what would you prefer to see them do?
Well, I think they should move slowly, and I think Janet Yellen and company know that not much is certain in terms of what that mythical or that new neutral interest rate is going forward. I think we're going to see a 25 basis point increase in June of 2015, but I think for the next 3 years thereafter, let's talk about 2018, that probably short-term rates will only rise to perhaps 2% as opposed to the old normal, which would be 4 or 5%. So, this period of time going forward, we'll see a period of higher interest rates, but much lower than historical norms.
So Warren Buffett today saying on a rival business network that he thinks 2% growth long term for this economy is a good thing. Do you agree?
Well, it's not what it was. You know, the 2% is a number that I would agree with. It's what has been advanced by the IMF and by the World Bank and by you know, the CBO in the United States. It's a new structural growth rate which, you know, reflects a lower level of productivity and a lower level of labor growth. But 2% is not 3 or 3.5%, which is what the economy has been used to over the past 10 or 15 years, beginning in the early 1980s. And so, you know, if that type of number, if that type of growth rate, 2%, is what we can expect going forward, profit growth will be lower, stock price increases will be lower, and certainly bond returns will be lower as well. And that's what investors must, you know, gear up for with a 2% growth rate.
And when you look at that number, wouldn't you rather see something a little higher? I mean, look, we've been waiting for decent job growth, income growth in this country for some time. I feel like we've been constrained. Don't we need a faster growing economy to really put people to work?
Well, we do. But, you know, we know much about the labor force in terms of its growth rate demographically, and we know there are a lot of people that have dropped out of the labor force, so a lot of people that are willing to come back in if we have a higher growth rate. You know, that growth rate, aside from labor, depends on productivity and investment in the real economy. And what we've seen over the past 5 years is certainly a lift in terms of investment prices and finance prices, but we haven't seen an uplift in terms of investment and capital spending. And so, you know, that 3% growth rate, that 3.5% growth rate, which is historical and ideal, as you point out, you know, probably requires a much higher level of investment in the real economy as opposed to the financial economy.
Bill, before you go, I just have to say, I hear you got an inch of snow out there in Newport Beach today.
Well, it's raining out here, but it's not snowing. I feel for you back there on the East Coast.
You have no idea. An inch of snow sounds like heaven. Bill, thanks for coming on. It was great to talk to you. Thank you so much for your time.
You're welcome. Thanks for having me.